If you've been following the financial news lately, you've probably seen a lot of buzz around India's public sector banks. I mean, they're everywhere. After years of kind of lagging behind, they are suddenly posting some incredible returns. So what's really going on here? Is this a genuine turnaround story, or is it just a temporary blip? Well, let's dive in and really unpack what's behind the Nifty PSU Bank Index. I want to start with just one number, 54.9%. Any guesses what that might be? It's a huge figure, and it tells you almost everything you need to know about just how massive public sector banking is in India.
That's right, over half. Public sector undertaking banks, or PSUs, hold more than half the total assets of all commercial banks in the country. Now, these are the banks where the government has the majority stake. And this isn't just some big abstract number. It means they are the absolute bedrock of India's financial system. They're critical for pretty much everything, from giant corporate loans all the way down to government social programs.
So, let's say you want to invest in this financial bedrock. One of the simplest ways to do that is through an index fund that tracks these banks. But before you even think about that, you've got to understand what you're actually buying. So, let's pull apart the Nifty PSU Bank Index and see what's inside.
The easiest way to think about it is like a basket. Yep, a shopping basket that holds the shares of 12 of the biggest government-owned banks. So instead of trying to pick and choose individual bank stocks, which can be really tricky, an index like this gives you a piece of the whole sector's performance, all in one go. It's all about getting that broad, diversified exposure.
Now, what's really important to know is that this isn't just some random collection of banks thrown together. Oh no, there's a very clear, rules-based process to get in. So how exactly does a bank make the cut and get into this exclusive club?
Okay, so there are 4 main hurdles to clear. First, and this is a big one, the government has to own at least 51%, non-negotiable. Second, the bank needs to be a pretty big deal in the market. Third, its shares have to be traded a lot, showing they're liquid. And finally, and this part is absolutely key, how much influence a bank has in the index is based on its free float market cap. Now, what's that? It's the value of shares that you and I can actually buy and sell, not the giant chunk the government holds on to. This is super important because it reflects the bank's true market clout.
And this chart really brings that last point to life. Not all banks in this basket are created equal, not even close. The index is completely dominated by a few giants. Just look at the State Bank of India. It makes up almost a third of the entire index all by itself. Then you add in Bank of Baroda, Canara Bank, and Punjab National Bank, and boom, you're looking at nearly 3/4 of the entire index weight. What that means is, as these big 4 go, so goes the entire index. All right, so now we know what's in the basket, let's get to the juicy part. Why is it getting so much attention all of a sudden? For years, let's be honest, PSU banks were kind of stuck in the mud, weighed down by bad loans and, well, not being very efficient. But that whole story is changing, and fast. So what's really driving this incredible turnaround? This quote from the source material just nails it. It really captures the heart of the positive story. See, it's not just one thing. It's a powerful mix of these banks getting their financial health back, major government reforms, and a real return to strong, solid profits. Let's break that down a bit. First, and maybe most importantly, their asset quality is getting way better. Those non-performing assets, basically bad loans that aren't getting paid back, are finally shrinking. I mean, just a few years ago, NPAs were at crippling levels for many of these banks. Cleaning that up means healthier books, which leads to better profit numbers like return on equity and return on assets. At the same time, they're lending more money, which fuels growth. And the kicker? Even with all this good news, their stock valuations still look pretty reasonable compared to where they've been historically. And you can't tell this story without talking about the government's role. These proactive reforms have been a total game changer. We're talking about new laws to make them run better, special programs to boost efficiency, and even the creation of a so-called bad bank to help take legacy toxic assets off their books. This government influence is really a defining feature of the whole sector. Okay, so far it's a pretty fantastic growth story, right? But now, we have to take a deep breath and have a reality check. Because alongside all this positive momentum, there's a very, very clear warning label that you absolutely cannot ignore. Take a look at this. This is the official riskometer you'll find in the fund documents. There's no gray area here, no ambiguity. The needle is pointing squarely at very high risk. This isn't just a friendly suggestion, it's a formal regulatory classification. So the billion-dollar question is, why? It feels like a bit of a contradiction, doesn't it? If these banks are the very backbone of the Indian economy, how can an investment in them be considered so incredibly risky? What are the factors that push this rating all the way to the top of the scale? Well, it boils down to the classic risks that come with banking. You've got price risk, which means if interest rates rise, the value of bonds that these banks hold can fall. Then there's credit risk, the constant lurking danger that people and companies won't pay back their loans, especially if the economy takes a hit. And with any indexed fund, there's a small risk it won't track the index perfectly. These risks are just magnified in a sector that's so tightly woven into the economy and, of course, government policy. Okay, so we've got these two powerful competing ideas. On one hand, a really compelling turnaround story, and on the other, a very high-risk warning label. Let's put it all together and figure out what the bottom line really is for someone thinking about investing here. So here it is, the core dilemma, laid out side by side. The bull case, the argument for investing, is that you're getting a piece of India's growth story, with banks that are getting healthier and are backed by government reforms. The bear case, the argument against, is that you're taking on a very high risk. You're exposed to economic slowdowns, and hey, government policies can always change. It's the classic high-risk, high-potential reward scenario. So who is this actually for? Well, according to the source materials, it's for an investor who's in it for the long haul and is specifically looking for exposure to this one sector. They probably prefer a passive, hands-off approach. But the most important thing, the absolute deal breaker, is they have to fully understand and be genuinely comfortable with that very high risk label. This is definitely not for the faint of heart. And so that leaves us with the final big question, one that really only you can answer for yourself. When you weigh everything we've just unpacked, the incredible turnaround, the government's heavy involvement, and those crystal clear risks, is the potential reward of investing in India's financial core worth the guaranteed volatility that comes along for the ride? That's the central question to mull over.